And one, we are live. Hello and welcome to PropTechBuzz, a business podcast on global PropTech, where we talk to PropTech leaders, CEOs, founders, investors from all over the world and learn from them how to build and manage and scale a successful PropTech companies. Talking about PropTech leaders, we have one such leader today. He's Jordan Viniar. He's a general partner at Prudence, one of the prominent global venture capital firm investing in technology companies, leading to global transformation of the built world across real estate, construction, infrastructure, and climate adaptation. Jordan is responsible for new investments and works closely with existing portfolio companies to support founding teams. He currently serves on the board of directors at AI Clearing, Hemlane, Propexo, and Salus. Jordan has over a decade of experience across technology and financial services, both as an investor and operator. Before joining Prudence, Jordan was a VP at Goldman Sachs Investment Partners, where he served as a venture capital and growth equity investor across industries, investing in businesses including built technologies. So, with that, let's welcome Jordan. Jordan, welcome to PropTech Buzz. How are you doing today?
Thanks, Ravi. Doing well. Yeah, thanks for having me.
The privilege is ours, Jordan. I was looking forward to this conversation, especially after we covered the news about Prudence, a new fund. And ever since, I've been wanting to talk to Prudence to understand deeply about your mission, about what are you up to, and so on. So thank you for taking time out. Before we get into the meatier stuff, Jordan, about Prudence, I would love to know a little bit more about you. I briefly gave a background of yours, but still, would you help us navigate through your career trajectory and your journey to PropTech and to Prudence?
Yeah, definitely happy to do so. My journey to prop tech is a little bit different than I think probably many in the industry. I and actually, funny enough, none of my colleagues at Prudence actually have backgrounds in the real estate world. We're all technology investors first, and saw the large opportunity that many others see in this massive market that's unserved by technology. Started going deep on the sector and kind of naturally ended up in prop tech. Taking a few steps back, as you mentioned, I started my career in financial services, in investment banking at Goldman Sachs. And after a few years in the space, moved into the technology sector. Actually started as an operator, where I was part of a team that was building a digital auto lending business with capabilities that included lending directly to borrowers, but also partnered with some of the largest financial institutions in the world, such as Capital One and Ally Financial and Santander. And it was an experience that I still hold with me today, and that gives me a great appreciation for what it takes to build and scale product. Admittedly, I'll say with mixed results on our product, but hopefully much better results with our founders' companies. From there, I moved to the investing side at Goldman Sachs Investment Partners. We're actually started with a focus on fintech, given my experience in building the lending business previously. And what I started to see in, taking a step back to 2017, 2018 timeframe, was really interesting applications, first of fintech for the real estate sector, and then increasingly just really interesting applications of software for the real estate sector. And I also saw a sector that was the largest globally by GDP, but that had been incredibly slow to adopt technology, and saw a ton of parallels between what I had experienced in fintech and what was happening in prop tech, just about a decade kind of behind where fintech was. And so I started to go really deep on the real estate sector, on the prop tech sector, spent more and more of my time in the prop tech sector, including, as you mentioned, one of my bigger investments at Goldman, which was a company called Built Technologies down in Nashville. And I became convinced that it's where I wanted to spend all of my time going forward, given the relatively large market opportunity and the relatively small number of participants focused on it. So in 2019, I got connected with my now partner, Gavin Myers, and the rest of the team at Prudence, who'd been investing behind the global transformation of real estate. and had been one of the longest tenured investors actually in the space, having invested in the seed round of Compass in 2012.
Hmm.
So got to know the team there, loved what they were doing. We had a very similar kind of view on the future of prop tech and technology and real estate. So I came over in early 2020, and have been here ever since.
Got it. So did you say you were one of the early investors into Compass as well?
Yeah, so Prudence was a seed investor in Compass back in 2012, 2013, and then supported the company actually through the Series C. And so, as a firm, Prudence has been involved in prop tech for over a decade. It wasn't the entire focus of the firm back in 2012, but I think we like to say that that was one of the big kind of eye-opening moments for us, was just seeing Compass and seeing the relative lack of technology adoption, technology differentiation at its competitors, and just seeing the wide open space that existed in the real estate market. And so, yeah, we were early investors in Compass, and have been big supporters of the company ever since.
Nice. And they went public, and I think the revenues are somewhere north of $5 billion, isn't it?
Yeah, and they're
So
now importantly cash flow positive as well. So, I think a really good, kind of foundational company for the prop tech sector to just prove out what is actually possible. They're now, they're the largest brokerage in the U.S. and scaling, profitably, which is great to see.
excellent. Let's talk about Prudence strategy. How would you best describe what Prudence investment strategy is?
Yeah, it's a good question. So, I'd say, like, broadly, we define prop tech as anything that touches the physical world. So there are kind of more obvious subsectors like residential real estate, commercial real estate, construction. But we also look at businesses that are in the infrastructure space or logistics, or I'd say increasingly becoming focused on kind of climate adaptation. Um, from a stage perspective, we broadly invest at the early stages. So for us, that's defined as kind of seed through Series B is typically the range in which we play. Though we're just much more focused on the stage of the company than the name of the round. So we're typically looking a little bit less about, like, is this a seed stage company or a Series A or Series B, but really kind of where is the company in its life cycle. And what that means is we're typically investing in companies that have a product in the market, have at least some early traction that allows us to measure adoption, engagement, retention, repeat usage, whatever the metric is, that allows us to do the fundamental underwriting of understanding how a company will scale. And so we do that fundamental underwriting, and want to understand that with additional capital, the majority of our capital will go into scaling. And so, as in a way, we sometimes think of ourselves actually as early growth equity, or somewhat of a bridge between venture capital and growth equity in terms of the stage we play at. We tend to co-lead or co-lead rounds. So we're typically not a follower in rounds. I don't know exactly what the stat is, but I think something like 7 or 8 of our last investments have all been lead or co-lead checks. And one of the reasons for this is that we run very concentrated as a fund. So that means kind of anywhere from 10 to 15 companies per fund, which I think is a little unique at the early stages. And so each investment for us is highly considered, highly diligenced, and critical to the overall returns of our fund. And we're just really focused on quality over volume over here.
Nice. So concentration of fund for around 10 to 15 startups is what you look for every year. Is that how it is, or every
No,
fund?
that's in a fund. So so our, in over the course of an entire fund, which we'll typically deploy over the course of 3 to 4 years. So what that really means is, and you'll see consistently if you go back through kind of the announcements of our companies and go through the databases, it's probably between 2 and 4 new investments per year. And we're not specifically targeting a number. If we see 4 great companies, we'll invest in 4 great companies. If we only see 2 opportunities that we're really excited about, we'll invest in 2. But yeah, it's a small handful a year, leading to, call it 10 to 15 in that range for a whole fund.
And what would be a typical check size for these seed stage companies?
Yeah, it ranges. I mean, on the seed stage side, we can write checks kind of as small as 1.5 million. In the later stages, we've, between ourselves and some of our limited partners and partners we invest alongside, we've spoken for, 10, 15, $20 million in rounds in the past. Though the checks out of our fund will be a little smaller, but we just have a really broad range in which we can invest, which gives us flexibility to do seeds, but also to do Series Bs. And because we're very concentrated, we're also very sticky, and we reserve capital for follow-on investments in all of our companies. So if it's $1 million seed check, odds are we're deploying meaningfully more than that over the course of the company's life.
Excellent. And you're unique in a lot of ways. Okay, I'm curious to ask some follow-up questions there, but let's understand how Prudence distinguishes itself from other venture firms in the PropTech sector.
Yeah, definitely. So, I think I mentioned this earlier, and I think this is actually one of the interesting kind of unique differentiators for us, is that none of us come from the real estate industry. And so I think what that means is we can take a little bit more of a fresh look at how things are done and think about them a little bit differently, rather than having kind of any preconceived notions of what should or does exist in the real estate world. And I think because of that, we also tend to take a little bit more of a technical approach to investing, which leads us to invest almost entirely in software businesses, with a focus on, two verticals that I'll talk about quickly, which is data businesses and infrastructure businesses. That's digital infrastructure. And there are other themes that we'll invest behind, but those are just two examples of kind of the more technical types of businesses that we'll invest in. So just to give you an example, like on the data side, I'll talk about our Fund 2 company, Casafari, for a second. In Europe, across all of Central and Southern Europe, there's no MLS or multiple listing service, which, as you probably know, is kind of the underpinning of all of the PropTech solutions that you interact with every day on the residential side. So it's the underpinning of Zillow and Redfin and all of those types of businesses. What that means, though, is that there's actually no single source of truth for what is for sale and what has sold across the entire continent. The only source of data is these classified sites that are not really much better than Craigslist. And I don't need to tell you this, Ravi, because you're in Europe. And they often have listings for the same property with unreliable information. So, if you go on the largest classified site in Spain or Italy or France, you'll see the same property listed 10, 12, 15 times with different information. And what Casafari is doing is they're ingesting that information from today over 35,000 different data sources across Europe, and using machine learning to clean, deduplicate, index that information, delivering the first source of truth for residential real estate data in Europe. And the company to date has actually now indexed 350 million properties across Europe. Now you might ask, like, well, great, now you have that data, what do you do with it? And the answer is it's useful for a whole bunch of different players in the space. Think agents who want to help their clients better understand where to price their homes. Think institutional real estate investors who want to more accurately value potential acquisitions. We've had banks and governments call and reach out to aggregate that data. And it's just an example of a market the size of the US when you aggregate all of Central and Southern Europe, which is completely unorganized, and it's not even disorganized, but unorganized. And so Casafari is leveraging advanced technology to organize that market data. So that's one example of kind of the technical type of solution that we're looking for. On the infrastructure side, we found that real estate has a lot of legacy systems that are kind of broadly used, and set the standard for data capture and standardization. And over time, these solutions have been added on to these kind of core platforms, but not in a way that unifies and captures all of the key data and allows systems to actually speak to each other seamlessly. So to give an example of that, our Fund 3 portfolio company, Perpexo, in the commercial real estate space, there's a handful of property management systems or PMSs, including companies like Yardi or RealPage or Entrata, that act as the core system of record for large owners and property managers. And these are 30 to 40-year-old platforms with horrible technology that are notoriously difficult to integrate with. What this means is that any PropTech, or actually any company that wants to connect with owners, managers, residents of multifamily buildings, needs to do so through a connection to the PMS. And these integrations can take weeks or months to build and often require entire engineering teams to to monitor at scale. And so this is the kind of infrastructure that we're starting with. What PropTech has done is they've eased the pain of integrations by building a universal API platform that allows companies to build a single integration with PropTech and have instant access to any PMS platform. Not too dissimilar from kind of what Plaid had done in the fintech world, if you're familiar with that, but allowing you to connect with hundreds or thousands of banks all at once rather than needing to build those integrations one at a time. And importantly, you then have a ton of critical data for real estate owners, operators, and PropTechs that flows through the PropTech platform and gives them great insight into what's happening in the sector. So just a couple of examples of the flavors of the types of businesses that we look for, but it really is those more technical solutions that are solving data, infrastructure, software problems in the real estate world.
I love it, and I can now understand why being outside of traditional real estate brings a fresh perspective, because you're drawing a parallel from Plaid, you're drawing a parallel from fintech, and you're solving the tech and the infrastructure and the data side of things, which is definitely worth. That's
Yeah, and
definitely.
it allows us to rethink the way that these systems should operate. Yeah, I think it allows us to have a fresh perspective, which is great.
Excellent. So let's talk about the way you pick. You talked about the sectoral preferences. You talked about data and infrastructure. What are the attributes? Because I'm sure there are people who are watching this. They would love to know what are the kind of preferences that you have when you're looking for in a new investment.
Yeah. So it's a good question. And I'll kind of talk a little bit about kind of like just what we're looking for in a new investment. We invest at the early stages, but we're almost always looking for businesses that I mentioned have a product in market and where we can do where we have the data to do a fundamental underwrite. And there's a few factors that I think we're typically looking for in a new kind of investment as we do an underwrite. And some of them I'd say are a little more obvious, and some are maybe a little bit less. And we kind of weight them maybe a little bit differently than some other investors. One of the things that we obviously want to see is a massive market opportunity that is either, I'd say, underserved or entirely unserved by technology. And this is actually probably the most straightforward part of our underwriting, because in the real estate world, it's somewhat easy to find, or easier than other verticals. And one of the great things about PropTech is that you're not often competing with the likes of Google and Microsoft and Amazon, but rather 30, 40, 50-year-old companies that are deeply entrenched but unable to innovate. And so I gave the example of the PMSs. I gave the example of the traditional brokerages with Compass. So large market opportunity is one. Because we're typically underwriting businesses that have early traction, we do like to see, I'd say, a decent amount of traction. And the threshold depends on how long the company's been in market. But with really strong unit economics, that is increasingly important to us. And early signs that a company can scale capital efficiently. In today's market, I think the point on capital efficiency is really important. And it often takes companies some early capital investment to get a product in market. But companies are switching from kind of build mode to generating strong unit economics more quickly now than they ever have before. So looking for that. One of the probably hardest things for one of the hardest hurdles for companies to clear is we're looking for companies that are both differentiated and defensible in terms of the technology they've built. And that's a little bit of a nebulous concept, but is super important. And this can come in many forms. I think in terms of defensibility, we typically find that it's through some proprietary technology advantage, some data advantage, network effects, typical things that would give you a head start and then potentially lock you in as a market leader. And then lastly, we're looking for great teams. And I think there are a lot of funds that will say you should start with the team, and any great team can build a great product. I think we're a little more, I think we rank it a little bit lower potentially on how we underwrite our business, or we don't start with a team. Not saying that we don't need a great team. But I think in the real estate world, one of the unique things is that it can be really helpful to have a founder who has experience in the sector. And I think there's kind of one camp that says you should solve for raw horsepower, one that says you should solve for sector experience. And I think for us, it's somewhere in the middle. And just to give you an example, we have a Fund 2 company called Salus, which is building construction site safety software to help companies digitize and implement their safety programs in the field. And the founder comes from the construction industry, started as a field worker, went into management, saw this issue, understands the issue deeply, famously likes to tell people that he didn't own a laptop 7 years ago. And he's now successfully scaled the business to hundreds of customers across 4 countries with millions of dollars of revenue and a successful Series A raised last year. So, we see founders that come in just about every mold, something that we focus on. But I think the profile of founders we're looking for can be a little bit different.
Excellent. So till now, how big is how wide is your portfolio? How many companies that you have had for now?
Yeah, it's a good question. I should know this off the top of my head. I think we have 12 active portfolio companies.
12, and the sectorally they would be categorized under traditional prop tech, construction tech. How do you divide them into different sectors?
Yeah, it's a good question, and I'd say we don't think about it necessarily as much as like how we want to invest. I'd say broadly evenly split between residential, commercial, construction, and then increasingly looking at opportunities in infrastructure. And infrastructure is, you could call it kind of a subcategory of construction, but I'd say broadly evenly split between those 3.
Got it. Let's now talk about the kind of business models, the kind of investment that you would want to shy away from. So, what are those red flags? What are those business models that you would not venture into?
Yeah, it's equally as important as the ones that we want to lean into. So there are a few business models that I'd say we typically shy away from, and I think you'd see over the history of the firm that we rarely, if ever, invest in businesses that are doing what I'd consider to be like asset repositioning rather than technology transformation. And this would include things like co-working, co-living, lease arbitrage type business models. And it's not to say that we never have or never would, but it's pretty rare that we would invest in those types of businesses, given the focus on highly scalable and capital efficient software businesses. Now, I want to be clear, we will invest in businesses that have some transaction-based fee stream and are tied to a real estate transaction. It's more how close are you to an asset? And I think the asset repositioning is one that we've gotten a little bit less excited about. For companies that have fee-based revenue, I'd say it's not something we do a ton, but it's something that we've done successfully in the past, right? Compass is a great example. It's not a software business. They've built a lot of software, but the way that they make money is through, and they actually do make money on software, but they make money through fees associated with a real estate transaction. And one of the reasons we feel comfortable with those types of businesses is that real estate transactions are really large and companies can earn a lot and generate strong unit economics on a single transaction. And oftentimes, those that are close to a transaction often are the ones who need technology the most and use it the least. So I just wanted to caveat that nuance of, we will do fee-based revenue type businesses. Asset repositioning is something we lean away from. And then on a more kind of micro, kind of company specific level, I'd say capital efficiency is just really important to us. Not every investment is really going to work out exactly the way you think. And I think it's easier. I think it's harder for some founders to learn to be capital efficient than it is to be capital efficient from the beginning. And so it's just one of those things where if we see kind of a poor track record of capital efficiency, it tends to be pretty hard for us to get involved. And what we want to see is that businesses don't need a ton of outside capital going forward, which require fundraisers, distractions, dilution, things like that. And I think you've seen this big shift over the last few years, and we hope to continue to see it, which is founders talking about how little capital they've raised and not how much capital they've raised. And I think when people are talking about how much capital they've raised, that tends to be a bit of a red flag for us as well.
Got it. So in an ideal scenario, a founder who's raising capital should only be to capitalize their growth needs, but not for product market fit or validating their ideas, isn't it?
Yeah, look, I think every company will have an investment curve early on. And it's not to say we don't invest in companies that have burned a decent amount of company to where they get to. And typically the amount of capital that is consumed depends on the technical sophistication of the product and how hard it is to build. So you do see that, but what you really want to see are just early signs that a founder is able to go from capital investment to capital efficiency pretty quickly. And that's, I'd say, really what we're looking for, which is, how quickly have you been able to spend the money, transition to a more capital efficient motion, assuming that you're in market, and then very quickly get to a place where you're raising capital because you want to scale and because you want to, not because you have to. So we're very rarely investing in companies that we think have to raise capital going forward.
Jordan, I have a question which I had not planned to ask, but primarily there are many good technology solutions that these founders come up with. However, the nature of real estate is such that they are poor adopters of technology. Do you agree to this sentiment that real estate, in comparison to all the other industries, has been traditionally a very slow adopter to technology? So, in spite of founders coming up with really great solutions, the adoption speed has not been there. So would you agree to this, and what are your thoughts around that?
I think it's probably, as with anything, a little more mixed and a little more nuanced than that. I think there are certain profiles of people in the real estate world who are poor adopters of technology, who are slow adopters, who are unreliable adopters of technology. I think that's changing, though. I think what we've seen is that as broadly people have become more accepting of technology, the benefits of technology, as more better technology is out there, they're adopting more quickly. I think we probably see this best in the construction space, where like historically you would have said, oh, like construction companies are horrible adopters of technology. Well, they've all been using project management software for like 20 years. And if you look at the tech stack of some of the bigger construction companies, like they are massive users of technology. If you look at the commercial real estate space, people are using technology for everything from access control in a building to the way that they are sourcing and onboarding and ensuring compliance of vendors, like our company Vendor PM, right? It's just used across the stack. And so I actually don't think that people are poor adopters. I think a lot of it probably has to do with the fact that like some of the solutions were historically poor, but now that the solutions are there, now that people are comfortable with technology, I think they're increasingly becoming better adopters of technology.
And I also have a theory here, because in the real estate especially, there has been a change of guard now. The management is now, the new management comes in, which are digital natives, okay, and they have their propensity for adopting technologies is better. So we are in a sweet spot where the old guard is changing hands, and there is more likely for acceptance of technology, right?
It's absolutely true. And it's similarly, you see that in every sector, right? You see that in commercial real estate, where you might have had a family-owned business that's now handed over to a younger generation. You see it a lot in construction, where you have younger generations of folks coming up through the ranks, and wanting to use and adopt technology, and they're digitally native and mobile native. So yes, I completely agree with that.
Got it. What are a few PropTech verticals or themes that you are considering prime for investment, and not just you, maybe across the spectrum, across other VCs and other investment firms?
Yeah, it's a really good question. I think I'll probably take this one more towards themes than verticals, and part of the reason for that is, like, as I mentioned, I think almost every vertical in PropTech is still investable. So we're seeing interesting companies everywhere from residential through infrastructure. So the first thing I'll mention, and it may be fairly obvious, and I'm sure you are seeing this as well, is artificial intelligence. And we are just thinking about artificial intelligence and its impact on the real estate world every single day, whether it's underwriting new investments or looking at our existing portfolio companies. When underwriting a new business where AI is not the core product, we are constantly thinking about the ways in which either horizontal or vertical AI could replicate the workflows of companies we're looking at. Now, interestingly, I think when you're talking about workflow software businesses in the real estate world, there are actually a ton of workflows that are really hard to replicate with AI, unlike horizontal software, because there's typically the presence of a real world process. And I think the closer you are to a physical process with workflow software, the more human intervention you need in that software to manually update things. And so, we tend to find a lot that like it's actually hard to replicate software with AI in the real estate space, but we're always thinking about it, and thinking about the ways that AI could impact a new investment of ours, because you're just able to build software so much more quickly. You're able to build things using AI that you used to have to build using workflow software. For
Jordan,
companies where
Jordan, could you explain the difference between horizontal and vertical, please?
Yeah, just meaning, horizontal software, meaning anybody can adopt it across verticals, whether you're a construction company, whether you're, and a lot of those you would think of as, software companies buying software, right? Salesforce, horizontal. You can use it if you're a construction firm. You can use it if you're kind of in any other vertical. Vertical software being focused for real estate construction.
Got it.
And the reason I differentiate is, if you're building horizontal software that is adopted and used alongside other software, there's a lot of automation that can happen there. If you're adopting software that requires a little bit more human intervention and it sits alongside a process that is manual, so whether it's something that's happening in a commercial real estate building or something that's happening on a construction site, it's really hard for AI to actually come in and replicate all of those workflows right away. So that's the difference as we think about kind of like vertical versus horizontal software. Does that make sense?
Got it. Yeah, thanks.
So that's AI in the context of companies that are not AI companies. I think, there's another kind of bucket of companies that we look at where their core product is AI. And I think there are different flavors of AI companies. And to kind of simplify the way, like massively simplify the way that we think about those types of companies is we look at them on a spectrum of, is the AI proprietary or not? Meaning, have they built it or are they leveraging third-party AI? Then we look at, is the data that is underpinning that AI proprietary or not? And it's probably fairly obvious, but the least compelling opportunities in AI are companies where neither the data nor the AI are proprietary, and the most compelling opportunities are those where both is proprietary. And just to give you a quick example, our latest investment is in a company called AI Clearing. The company is leveraging drone imagery and computer vision to give real-time progress tracking and quality control on infrastructure projects. So think things like solar and railways and roads and bridges and tunnels, these massive multi-$100 million infrastructure projects. And the reason we love that company so much is they spent 3 years developing their own proprietary AI with a team of 30 engineers and data scientists, which is really hard to replicate. They also spent years gathering drone imagery data from real infrastructure projects to train those models, and have developed by far the best technology in the industry. And so you think about proprietary AI that's theirs, that's not off the shelf, proprietary data that they've spent years capturing. It's just extremely hard to replicate. And so the company went to market, and now they have 4 of the 20 largest global contractors using their product because the technology is just so far ahead of the competition. That's like, I'd say one of the big themes is AI.
So Jordan, before we shift from AI, so would you then imagine anybody that is capturing a lot of proprietary data, okay, by virtue of, say, providing some services and stuff like that, and then they are more likely to add an AI model so that they can actually model all this proprietary data, and then they will have a lot of leverage which others might not, right? Would that be a fair consideration for you to be?
Yeah. Absolutely right. I think in any case, you want a company to have proprietary data. And if you do, it makes the potential adoption and expansion into AI type services so much easier, because you can train an AI. Like the benefit of an AI model is it's only as good as the data you train it on. And if you have your own proprietary data, you can just train it to be better than anybody else's. And so that's why it's like, we like proprietary AI, proprietary data better. But if you have proprietary data and you can use third-party AI tools that exist out of the box to deliver value,
Right.
you should. And we're still excited about those opportunities. And certainly with our companies that have proprietary data, they're constantly thinking about ways to layer AI on top of that.
Excellent. Sorry, I distracted you. So post AI, what other themes do you see?
Yeah, no worries. So that's kind of like one big and obvious one. There's one other I'll mention. which we sort of jokingly call services as software internally here at Prudence, which is a little play on like software as a service. And it's kind of a category of companies that are providing software, but wrapped in a bit of a services layer. And they're often monetizing primarily via fee-based revenue, but doing so by providing value via software. And I'll just kind of give you an example from our portfolio. So we have a portfolio company in our second fund called Morty, which is providing an entirely software-based operating system to mortgage brokers and brokerage teams that allows them to run their business and originate loans on the Morty platform. So they've built the automation to ingest customer information, provide real-time rates from dozens of lenders, speed the time from lock to close, helping borrowers get the best possible mortgage and helping brokers get more loans closed. And they're able to do that through software, but the end product is a service to the consumer. And somewhat counterintuitively, I think like these kind of services as software businesses need to provide the most technical sophistication because of the services heavy nature of their revenue streams. And they're transforming these historically human capital intensive processes through the use of technology. And they need to provide kind of like order of magnitude better efficiency in order to get adoption. And so again, using the example of Morty, loan officers using Morty can do like 10 times the number of deals in a month that a traditional loan officer can do, because the technology is doing so many of the tasks that a traditional loan officer would do. So that's one of the other themes, is kind of this like overlap of services and software, providing software to enable kind of efficient delivery of services.
Nice. Excellent. Anything else to add, Jordan, or shall we move to the next question?
Oh, those hopefully cover two big themes we're looking at.
Got it. And let's also talk about some fads. Okay, there are some trends that come with overalls. You never know whether they are gonna stick or they are just seasonal fads. What are some of the trends that you think are fad and will die out in the upcoming years?
Yeah, it's a good question. I'll be careful in how I answer this, because I don't want it to sound like I don't think these things are investable at all, because I don't believe that. And I think the first one is climate investing. And I don't think that climate is not an investable sector or is a fad. Having said that, I think there's been what I'll call kind of like a meaningful overallocation of capital into climate technology that is either unproven or undifferentiated. And if you look at kind of the amount of capital that has been raised into climate-focused funds, I think there's a need to deploy that capital behind all different types of climate technologies, whether that's software or real-world climate solutions. And I'd argue that there will probably be a good amount of value destroyed chasing early and unproven technologies due to the fact that some of these funds need to deploy capital. And I think back to like my early investment banking days, and there were I remember looking at climate technology solutions in like 2008, 2009 that were unproven and undifferentiated, and there was a lot of value destroyed in kind of the late 2000s on investing behind those types of technologies. And I think what we've seen is there's a long history of clean energy technology that it takes a long time for it to start to prove economical. And solar is like a really good example of this, right? Solar has gone from one of the most expensive generation technologies to the cheapest generation technology, but it takes a long time, and you need to be really thoughtful about where on the curve you want to invest and when it's time to invest. So I think there will be massive winners in the sector. I don't want to say that climate is not investable, because I think it is. But I think there's probably on the margin a little bit too much capital flowing into climate solutions today.
So when we talk about solutions, primarily the crowded market is about decarbonization platforms. Right? So there are lots of people who are decarbonizing, and that is where the crowd is. So is that where you see that there could be a lot of consolidation or a value lost, or it could bust because they're not meaningfully solving the climate problem?
Yeah, and I think you're seeing that on both sides, right? You could say that you're seeing that on the software side, where people are helping to monitor carbon emissions, and then you're also seeing it on kind of the physical real world solutions, whether it's carbon capture or other technologies. So I think that's right. I think it's really about kind of like carbon emissions.
Got it. Got it. All right. Thank you. The kind of money that is being pumped into climate or eclipses the money that is pumped into PropTech. No, I think the
I,
numbers are somewhere around a trillion dollars that is going to climate, and you see that as a red flag, isn't it?
Yeah, look, I think it is, and again, I'm like, there will be winners in the sector. There will be massive outcomes in the sector, and it's going to take some risk. But I also think there's like there's a you have to be thoughtful about what the right time is to invest in the life cycle of this technology.
Mm,
And a lot of these real world technologies just take a very long time to prove out and start to become really efficient.
got it. Got it. Excellent. How has your exposure been on the climate side? Have you been investing on the climate side, or you have been wary for that sector?
Yeah, I'd say kind of like around the edges. We have been, I mentioned AI clearing before. Their core market is solar, and so they're one of the core infrastructures that solar developers are using to track their solar projects, and through that, ideally enabling kind of like faster construction and better construction of solar projects. So, that's kind of like, I'd say, around the edges. We're looking at a lot of climate kind of software type solutions. One of the things we're really focused on and really kind of like waiting for is making sure that when we're investing in a climate business, the technology is being used because there is a positive ROI, not just being used because it's forced to being used by regulation. And I think there's always risk to an over reliance on adopting technology because of regulation versus positive ROI. And especially in the US, where climate regulation is politically fraught, and you never know what's going to happen depending on who's in power. You just want there to
Mm.
be some real economic benefit of adopting climate technology.
Nice, nice. Yeah, but better to be safe than sorry. Okay,
Yeah.
once things consolidate, once we have the policies laid out concretely, I completely understand. Let's talk about your investment. Every investment strategy or thesis is based upon the trends, okay, the economic trends and the industry trends. So, how have the recent industry trends and the economic trends shaped your investment strategy?
Yeah, that's definitely a loaded question given what's been happening economically and in the real estate world the last couple of years. It's investing in the intersection of technology and real estate the last couple of years has been a really interesting place to be, because you've had technology kind of valuations fall off a cliff between 2021 and today, changing the entire landscape of venture capital, given how people have been investing in 2020, 2021. Additionally, on the real estate side, you've had the kind of dual impact of higher rates and proliferation of remote work that have led to distress in residential and commercial and other parts of the real estate ecosystem. Um, and having said all that, like, not that much has changed at Prudence. And so I'd say, like, what we try to do is not get too high during the highs, not get too low during the lows. Um, but 2020 and 2021 were actually more difficult years for us because we couldn't square kind of the mania in the technology market with what we were seeing in underlying business metrics, and the companies that were getting those valuations. And there were companies that we liked a lot, but that we couldn't invest in because we couldn't get there on valuation. And to give you a little more context in that, we only made 2 investments in 2021. And they were both at kind of reasonable multiples, and both in Europe, where the valuations never got too out of control. And there were definitely moments where we kind of wondered if we needed to loosen our underwriting standards, put more capital to work, kind of like capitalize on what was a faster growing technology sector where people were raising more constantly and deploying more constantly. But in hindsight, we're glad that we stuck to our guns and remained fundamental in our analysis of each company. And it's easy to say now, but the compression of technology multiple, valuation multiples was not a crash, but actually just like a return to normal. And there's a very long history of technology companies trading within a certain band, and I think that's where they will trade going forward. And on the real estate side, I think it's very much the same story. Like, we're we've always thought about valuing businesses on mid-cycle volumes. And so when the residential real estate market was going crazy in 2020, we didn't necessarily want our valuations to reflect that. And the same way we haven't entirely pulled back from the residential market now that volumes are depressed. So just like the technology sector, there's kind of this long history of what these what the sector looks like through a cycle, and we just like to think about things in kind of a more cycle average mindset. So look, a long way of saying I think it's been a roller coaster over the last couple of years in terms of what the industry trends have been and kind of like how the market has performed. But nothing has really changed about the way that we think about investing. And if anything, it's kind of simply reaffirmed our belief in fundamental underwriting and just a really a patient approach to avoid making too many mistakes.
The way I perceive, and I do not know about Prudence. You are my you are the brand ambassador of Prudence, and the way the conversation is shaping, it seems like Prudence is more like conservative, grounded on fundamentals, and capital efficiency and strong fundamentals. Am I right? Is that the soul of Prudence?
Yeah, look, I think that's a good way of saying it. And look, I don't want to make it seem like we're too conservative and that we won't be aggressive in trying to win deals, pay premium multiples for businesses that deserve premium multiples, but just being thoughtful in the way that we allocate our capital. Like our investors trust us with their capital, and therefore we need to be good stewards of that capital. And the way that I think is authentic to us in doing that is making sure that every investment decision is highly considered, and that we don't get too high during the highs and we don't get too low during the lows. And it can be very hard to do that, but that's the kind of ethos that we try to invest with.
And has this ethos or the philosophy paid off as well? I'm sure it has, right? Because you have been so thoughtful. So have you been performing well with your portfolios?
Yeah, look, I like to think so. The real answer to that is, ask me in a couple of years, because these are these funds are they're 10-year fund lives for a reason in venture capital, because you find out a lot more about your investments in years kind of like 5 through 10 than you do about in years 1 through 5, and you learn a lot in years 1 through 5. So
But there are some leading indicators, right? I mean, I'm
yeah,
sure
definitely.
yeah. So I mean,
Definitely. And no, to answer your question directly, we feel great about where our portfolio is. We have a set of founders who know their products well, know the markets well, allocate capital efficiently, are in strong liquidity positions, and have like really big market opportunities ahead of them. Will they be good outcomes, great outcomes, or home runs? That's what we'll learn more about in the next couple of years.
got it. Got it. Also, let's come back to my question that I had asked about the skepticism in the media about PropTech over the past few years. Especially driven by high-profile flame out, some of the biggest companies in the sector. Um, so, given this uncertainty, what makes you excited about the sector?
Yeah, it's a great question. I think like if you follow, just search for PropTech on TechCrunch, and you see like a lot of people writing the obituary of PropTech late last year, and like we couldn't feel any more differently. I think we're still in the very early stages of technology adoption in the real estate sector. And when you think about the amount of capital that's flowed into sectors like fintech and like biotech in the last couple of decades, the investment of technology in real estate is a drop in the bucket. And one of the reasons I think there's so much skepticism is that a lot of the businesses that raised a ton of capital and gained a lot of publicity early weren't actually high quality technology companies.
Mm,
And many of these companies raised a lot of capital because they required a lot of capital to build,
mm,
meaning they were less reliant on software. And many of them were actually just digital ways of doing doing things that had been done before.
mm,
And we think of this as like PropTech 1.0, right? A lot of companies that scaled with access to capital and digital marketing, but without a sustainable technology differentiation.
mm,
The most well-known of these companies mostly went public or merged with SPACs in 2020, 2021, but have performed very poorly in the public market since.
mm,
And even at the time, it was pretty clear to us that a lot of those companies were not merging with SPACs or going public because it was the right access to capital, but because it was potentially the easiest access to capital,
Right.
and certainly not because they were ready to be kind of ready and prepared to be public companies. And so, I think you had kind of like the wrong set of companies that became the poster children for the prop tech ecosystem. And in reality, as I just mentioned, it takes a very long time to build high quality businesses. And given the relative newness of prop tech as an
Mm,
investable category, we think that the best companies are still being built and aren't broadly talked about today. And we like to
mhm,
think that a bunch of those are in our portfolio. And just to kind of give you a flavor of one of those, like our portfolio company Crexi is an awesome example of that. It's probably one of the largest private prop tech companies that no one ever talks about.
mm,
But we believe it's going to be a category defining business. And they've a little bit taken on CoStar for better or for worse, by offering free sales and lease listings on their platform. And then they sell workflow and data tools to buyers, sellers, and brokers of commercial properties. But just to give you like a couple of data points that you can see on their website as well, they have millions of monthly active users.
mm.
They've marketed over $7 trillion in real estate value on their platform. I'd encourage you to go on Twitter and search for Crexi and see like the love that exists for a platform like Crexi in the buyer, seller, and broker community.
Mm.
And I think like these are the types of companies that will define prop tech, and eventually drive kind of renewed excitement in the sector. But they're still early today, and so that's a great one. Where like hopefully a couple of years from now, people are talking about Crexi as a category defining prop tech company.
So let me ask you a question. You mentioned about so many companies, the private companies that are unknown, those are hidden gems, right? So for companies like for VCs like you, Prudence, how do you ensure that you get access to these hidden gems? You get access to good deal flows. What are your ways to attract startups your way?
Yeah, look, I think probably back to the ethos of like, the way that we operate. Our view is that in the long run, by being a smart, thoughtful investor and a good partner to those in the sector, there will be kind of this flywheel effect of companies coming to you rather than you needing to go seek them out. And that doesn't always happen, but we do have this perspective that if we find good deals, work closely with our founders, help them scale their businesses, help them raise capital, just act as good partners. There will be, it will create this flywheel of positive feedback from our founders. Our founders are oftentimes our best advocates and best sources of deal flow. And increasingly, as we've been around for longer, we do have founders, the best founders and best companies seeking us out. We will never see every deal in the market. We are not the biggest team. We are not the biggest fund. But for us, it's about finding the right deals, the right founders. We are certainly proactive in making sure that we're seeing the companies that we want to see. But more and more, we're having people come to us because they hear that we're a great partner.
Why do you double down on your working relationship with these founders on the companies that you invest? Okay, what does a good partner, acting as a good partner, mean? What kind of support do you offer? How do you ensure that you are not meddling with their business, but you are actually acting as a catalyst? Could you give us a sense of what does a good partner relationship look like?
Yeah, I always try and be careful when we tell founders that we take an active role and take board seats and work closely with them, that they understand that we're not trying to run their business, because we're not, right? We're trying to be helpful and supportive. There are many tangible ways in which we can help founders, right? Like we have large networks through which we can source, uh, you know, high quality candidates for certain roles. We have good relationships with lenders, with other investors, where we can help folks in capital raising. We have great relationships in the real estate world where we can make potential customer introductions. So we can do all of those things. I think the one thing that we say to our founders, and if they're doing this, this is kind of means that we've been successful, is we want good news fast and bad news faster. And if they feel comfortable calling us with bad news faster because we are a good partner, a thoughtful partner, we're supportive, we help them think through problems. For a lot of them, it's the first time they've ever done this stuff. And we've seen this many, many times over the course of decades, combined with our experience at Prudence. I think that means we've been successful. And I would say, look, I think the vast majority, if not all of our founders feel that way. And so it's a mix of those kind of like tangible and intangible things that we do to drive value to our companies.
Excellent. Let's now talk about the last one here is about the fundraise. In fact, our media on PropTechBuzz, we covered this news about your third fund. What does the evolution of Prudence look like over time as you invest out of Fund 3 and start thinking about raising Fund 4?
Yeah, it's a good question, and maybe a boring answer, and maybe somewhat consistent with some of my other answers. But I think it's a lot more of the same. Like we like to be fairly steady here, and we're really happy with our strategy. And I think, look, we are always learning. We're always adjusting around the edges. But we're investing in a way that's authentic to us, and I think by continuing to do so, that's how we'll have the most amount of success. I appreciate you covering the fundraise, and it's been great to get the publicity. We're still very early, obviously, in the deployment of that fund. We just announced it earlier this year. And so really for the next couple of years, we're heads down looking for great companies, actively helping our portfolio companies, as I mentioned. And, the goal for Prudence is not to become a multi-billion dollar, go out and raise multi-billion dollar funds and get into the asset aggregation game. Because I think that would fundamentally change the way that we need to think about investing. And I think we'll model ourselves more like funds that kind of stay within a certain band that they're comfortable with for a long time and feel they can generate really strong returns. If actually sometimes you limit the amount of capital that you raise in a given fund. So look, we've been able to achieve a lot with a relatively small team, and I think we'll continue to do so.
Excellent, Jordan. Thank you for taking time out. It was great talking to you and understanding the philosophy of Prudence. I must say I've spoken to a lot of VCs, lots of investment firms, and Prudence, as the name suggests, is actually prudent in the way it makes choices. So, and I'll see how we could be of help through PropTechBuzz to passing out some of these deal flows your way as well. With that, thanks so much, Jordan.
Great. Thanks for having me today.
Bye-bye.